Hello and welcome back to the channel, Implied Investing. Today, we're going to take a deep dive into FIRE, which stands for Financial Independence, Retire Early. And we're going to look at the 4% rule, or is there another way? Can you sustain FIRE with covered call ETFs? Now, I realized the impetus for this video was that I realized that I talk about my fire investors, and I was like, let me explain exactly what I mean by my fire investors. Fire investors are people, like the name implies, who are trying to reach financial independence and retiring early. And to do that, they invest aggressively into the stock market, and then they draw down 4% a year. But before we take too far of a deep dive into it, let's look at what they invest in. So your typical fire investors, we're on Seeking Alpha. This is what they'll typically invest in. They'll invest in VU, representative of the S&P 500. They'll invest in VTI, which is the entire US stock market. They'll invest in VT, which is the entire global stock market. Or if they didn't pick VT, they'll do some combination of VU, VTI plus VXUS for that international exposure. Sometimes they'll do 90-10, 85-15, or just a little something to get that international exposure. And the idea of it is to aggressively save for a couple years. Typically, depends on where you are and how much money you make, but typically they'll save anywhere from 30 to 50% of their income over while they're building up their fire number, while they're building to their fire number. This is called the accumulation phase. And then in the drawdown phase, they will withdraw what's called the safe withdrawal rate of 4% of what got built up. And you may say, wait, you're drawing down 4% every year and you only been saving for 8 years, you're going to run out of money. That's not necessarily true. It depends. So let's look at how this works in detail. So if you look at the 1 year chart, you see that the S&P 500 gave you 19%. The total US stock market gave you 19.2%. VT gave you 24.99%. VXUS gave you 35%. Now, mind you, do not expect this from VXUS on a regular basis. International stocks went on a tear. But if you had $100 invested into, let's say, the S&P 500, you see over 10 years, it went up 266%. So you more than doubled your money. That $100 has become $200 and some change. I'm sorry, it's become $300 and some change. It's doubled your money. You already had $100. And that's the concept of it. So if you had $100,000, now you'd have $300,000. That is the concept of the operation. That's how it works. You build up to this fire number, which is typically 25 times your annual expenses, and then you withdraw 4% a year. Now, the 4% is offset by the normal market growth. So typically the stock market will give you 8 to 10% returns over time. Of course, some years you're going to have high returns like last year in 2025, and some years you're going to have low returns like in the lost decade. But over time, typically you can count on 8 to 10%. Now, there is something called sequence of withdrawal risk, which means that if you retire into a down market, now you're selling a sustained bear market. So we're talking like 3, 4 years, 5 years worth of a bear market, and you're selling your assets at less than what they're worth. That is a risk. And I think the statistics say that fire works for the safe withdrawal rate works for about 80% of people. But for that 20%, if you're in that 20%, fire is not going to work for you because of when the time that you retired. You may have to delay retirement. You may have to go back to work. That's just a risk that fire people take. And you really need to determine if can you sleep at night knowing that that's the type of risk that you're taking. But this is their typical investment. Their strategy is aggressive saving and compounding over time. But today we're going to look at perhaps a different way to do it, and we're talking covered call ETFs. So let's move on to the next page. I'll go into that a little bit. So fire is not done the exact same way by everybody. You have lean fire. Lean fire gives you a annual income of $30,000. If you break that down, that's about $2,500 a month to live off of. And with the 4% rule, meaning 25% your annual expenses, you would need about $750,000 saved up in order to do the safe withdrawal rate and live off of 30K a year. 30K a year, you can live off of it, especially if you're not in a very expensive state. You can live off of it. Let's say you like to paint, or you like to go to the beach, or go work out, or go hiking. These things don't cost a whole lot of money, and because you don't have to go to work, and you probably cooking more of your own meals. You're doing less with you're driving less, so you're saving money on gas. This is a very doable this is a very doable fire, right? Lean fire. And especially if you're not in the US. If you say, hey, I'm moving to Bali, I'm moving to South Africa, Portugal, you may not make it with lean fire, but you could go to Latin America, or to all the digital nomad hotspots. If you hit lean fire, $750,000, you can go over there and live a very, very comfortable lifestyle. Now, going over to the traditional fire, which is 60K a month. To live off the traditional fire, what a lot of people aspire to, you need $1.5 million. $1.5 million to do a safe withdrawal rate of 4%. This will give you about $5,000 a month. $5,000 a month. And that is pretty comfortable, especially if you're not in a high especially if you're not in an expensive state. You can sustain a very decent, comfortable lifestyle, very, very middle class. Now, barista fire is a little different. FIRE stands for Financial Independence, Retire Early. With Barista Fire, you may have retired from your career, but you're still doing a little work on the side. You're still, maybe you picked up, maybe you have a hobby and you found a part-time job that'll pay you to do your hobby. So I know some people they like flowers, they like painting, they like working at an antique shop. It's not a whole lot of money, but it is a little something that's coming in, and people who do Barista Fire, Barista Fire sometimes also do this because of the benefits, such as health insurance. It's not always just about the paycheck, it's the health insurance. And you have, let's say something happens in the market, you can switch over and just really lean more heavily on that steady paycheck that you have coming in. So Barista Fire, you typically will have 30K coming in, 30 to 20K coming in from your portfolio, and 20K coming in from your job, or your part-time job. This equals about $3,333 a month. And to typically hit Barista Fire, you need a nest egg of about $1 million. You need a nest egg of about $1 million. And then there's Fat Fire. Fat Fire says, "Hey, I want to live just like I was living, or better than what I was living when I was working, when I'm retired." To hit Fat Fire of having $160,000 worth of income annually a year, that's a $13,333 a month. You need $4 million saved up. You need $4 million saved up. And that is quite a bit of money. That's out of reach for a lot of people unless you are making really, really good money. But it is doable. That's what Fat Fire. These numbers, don't please understand that these numbers are an aggregate number. What's widely agreed on On Reddit, you're going to find different type of takes, but these numbers are widely agreed on in the fire community as to what these no, what the income is for these numbers. Now I'm going to give you the numbers if you decide that you want to do it with covered call ETFs. Now, the covered call ETFs, let's go back to Seeking Alpha and take a look at the covered call ETFs that we're going to be working with. So let's edit the symbols. This is one of my favorite features about this about this website is that they allow you to do these comparisons. And before we go any further, let me be clear. I am not an investment professional. This is not investment advice. It is for education and entertainment purposes only. Before making any financial decisions, please consult an investment professional. Okay? With that out of the way, I'm free to proceed because using covered calls it comes with its own risks. So we're going to use GPIX, which is Goldman Sachs S&P 500 Premium Income ETF. We're going to look at GPIQ, which is the Goldman Sachs Premium 100 Premium Income ETF that's built off the NASDAQ. We're going to look at SPYI from NEOS. Ooh, it's SPYI from NEOS. And we're going to look at QQQI from NEOS. SPYI is built off the S&P 500. QQQI is built off of the Nasdaq. So we're on these funds aren't very old, so you can only look at 1 year, and we're going to look at two things. We're going to look at their price return, and in 2025 they had very decent price returns. A lot of older generation covered calls, like systematic covered call systems, don't really have that going for them. One of the things about the guys at Neos is that they use covered call spreads, so you do get to participate in some of the upside. And GPI, Goldman Sachs, GPIQ, and GPIX, they use a partial coverage. So once they hit their rate, they can cover anywhere from 25 to 75% of the fund to generate those premiums. Let's go down and take a look at their dividend rate. You're looking at 8% with GPIX, 9% with almost 10% with GPIQ, 11% with SPY-I, and 13% with QQQI. The expense ratios are different in these funds, and that's something to be mindful of. With traditional fire, you're not paying a whole lot. VU is very cheap. VXUS is very cheap. VTI is very cheap, but these funds are normally quadruple the price, double and quadruple the price. So QQQI 0.68, 0.68, 0.29, 0.29. Similar returns, but the NEOS funds do appear to give to have higher returns. I mean higher dividend payment, higher disbursements, and they have slightly lower uh, price return. So 5.3, they're in the 5 range, and these are above 8. These are both above 8. So they're really bringing in the money, but they are also not paying you as much. All right, back to our presentation to go over the price difference. The price difference. This is what the people want to know. So to reach the same results, to reach each different type of fire, to reach the lean fire with a covered call ETF, let's say you decide that you need $2,500 a month. To reach that with GPIX, you only need, well, with lean fire, you need $750,000. With GPIX, you only need $375,000. To reach that income of $2,500 a month with GPIQ, you only need $300,000 a month. To reach it with SPY-I, you only need $250,000 a month. And to reach it with QQQI, you only need $220,000 a month. That's a 70% less money saved to do $30,000 a year with QQQI. I want to let that sink in. That is 70% less with QQQI to reach lean fire. And we're going to go down and make sure that I'll give you the numbers for all of them, including including the traditional barista and fat fire. So I'm going to start going a little bit quicker. To reach traditional fire, you typically needed $1.5 million to generate $60,000 worth of income or $5,000 a month. With GPIX, it's 750. With I'm sorry, with GPIQ, it's 600,000. With SPYI, it's 500,000. With QQQI, it's 441,000. That is less than $500,000 to live a very good middle class lifestyle with $500,000. With Barista Fire, Barista Fire is going to be less than a traditional fire, but you'll also have that job. So you'll have this high income coming in and you'll still have the money coming in from your job. So just with QQQI, you'll typically need $294,000, so a little less than 300,000. With GPIX, you'll need 500,000. That is a little pricey, but remember, you still have a job and you're still putting money toward it. And with Fat Fire, which is living off of a whopping $13,000 a month and bringing in $160,000 a year. With GPIX, you need $2 million, so you automatically cut that in half because you used to need $4 million in order to do that. And with QQQI, you need $1,176,000. I'm sorry, $1,176,471 dollars. And it's still a savings of about 40%. So if you want to live the high life and you can save $1 million, then go for it. I know me personally, I'm closer to the traditional fire. Um, I'm closer to the traditional fire, but it is a trade-off that you're about to give, and we're gonna get into those trade-offs. So I want to look at some projections as to what you're giving up. Because remember, covered calls sell the upside of your sell the upside in order to generate that income. So with going over the 30-year projections, yes, you can live large now, but over time, remember, the traditional fire investor is only drawing down 4% while the market is still giving back 8%. But you're capped. If you decide to use covered calls, you're capped, so your returns won't multiply the same way. So let's say a lean fire person who starts off with their $750,000. In year one, the balance of their account will move up to 792,000. In year five, their account will be 995,000. In year 15, their account will be $1,800,000. And by year 30, they will be at $6 million in their bank account. Their annual income will for year one be 30,000, for year five will be 33,000, for year 15 will be 45,000, and for year 30 will be 70,000. So they start lower, but they end up very wealthy and they're making $70,000 a month. Now there's make sure there's a caveat. Remember this: the older you get, the less stuff you're going to be doing. If you're young, you're going to be doing the traveling. You're going to be going out. You're going to be going to dinner. If you're single, you're going to be taking people on dates. There, being young has some expenses that come with it, but with the traditional fire investor, they're going to get wealthy later, later in life when they don't really necessarily need the money as much. Now, let's say that you do the same thing with QQQI. With QQQI, you start off with $220,000 and you're still making that $2,500,000 a month. But by year five, whereas they now have $995,000, you only have $284,000. You only have $284,000. Now your annual income In year one is $30,000. Same as the barista. I'm sorry, same as the person who's doing traditional fire, lean fire. You both start off at $30,000. By year five, you're bringing in $36,000, whereas they were at 33. By year 15, you're at $61,000, while they're at 45,000 a year. And by year 30, you're at $131,000, where they're at 70,000. But let me give you those ending balances at over 30 years. Over 30 years with the QQQI, you're only at $1 million. So the person who does the traditional fire has 6 million and you have 1 million. Now let me give you this. With QQQI, your monthly income at over 30 years is $10,000 and their monthly income is only 5,000 uh $5,891. So that's a trade-off that you need to be aware of. While your income will be higher, you will have less money and 6 times less money over the course of 30 years. By year 15, they have double the amount of money you have. You don't even have half $500,000 and they have triple the money. They have 1.8 million, but your income is still high. If you care about income, if you care about total net worth, it's it's a decision you're going to have to make. It's a trade-off you're going to have to make. Just make sure that you're making it with your eyes wide open. Now, the traditional fire path, this is the person who saves 1.5 million. The compounding for them gets insane. It gets insane over the course of 30 years. So year one for the traditional fire person, they start off with 1.5 million. They're drawing down 4%. They're making $60,000 a year. That's $5,000 a month. By year five, they're almost at 2 million. They're 1.99 1.99 $1,990,314. Their annual income is at 6,750 $531 and they're making monthly $568. So they got a $600 raise over 5 years. Now by year 15, their account is at $3.7 million, and by year 30, their account is at $12 million. Now, if you decide that you're going to go with, let's say, SPYI, by in year one you're at 500,000. In year five you're at 644,000. In year 15 you're at $1 million, and by year 30 you're at $2 million. Meanwhile, by at year 30, the person who's invested in VU and VT and VTI, they're at $12 million. They're at $12 million, but your annual income is $21,000 a month. So know that there is no free lunch and you are giving up your future money for money right now. And that may be 100% worth it to you. That may be 100% worth it to you. Just know that you are giving up money down the road for money right now. But you don't have to take these paths. You do not have to take these paths. And I want to show you guys what I plan to do. I plan to do a hybrid approach. A hybrid approach. The hybrid approach gives you, while it may not be the best of both worlds, it does give you both worlds. Because I know when I'm old, I want to have lots and lots of money I can pass on to my kids and my heirs and descendants. I want to try to create as much generational wealth and a cushion as I possibly can. But I also don't want to work forever. I also don't want to work forever. I want to try to travel while I'm young. There are lots of things that I want to try and do and relax. And you don't know how much time you have left. And every day that you wake up and go to that job is a day that you can't spend doing something that it is you want to do. So let's say that you were a um, traditional fire investor. You were trying to save up that 1.5 million and you hit that 1.5 million. You could invest 900K in growth, which is VU, and you can invest 600K in income. And here we're representing your income as SPY, but you could also go with QQQI. The numbers would be slightly different because QQQI pays slightly more. But if you did that, your income would be $72,000. Starting off with that 60K in SPY, you would have an income of $72,000 in year one. That is enough to go do what it is you're trying to do. That's a monthly income of $6,000. Or you could do by year five, not or you could do, but by year five, you would have 88,000. By year 15, you'd have 1.4. I'm sorry. By year 15, you'd have 146,000. And by year 30, you'd have 314,000 in in annual income. In annual income. You would end in 30 years, you'd be earning $26,000 a month. And these are really good numbers. I can live off that. I think I can live off that. Now your total balance by the end of 30 years with this growth and income portfolio would be slightly less than the pure traditional fire investor, but you'd end up having a good $18.5 million, which is really, really good. And you're still generating that income portion. You're still generating that income. And that's what I plan to do. I plan to do a hybrid approach. Now, I won't have 1.5 million by the time I hit fire. I will do a hybrid approach, but my hybrid approach will typically probably be a version of maybe 300,000 to 300,000 in a covered call ETF. And these covered call ETFs are paying 8 to 10%, 8 to 12%. I'll probably live off of 6%. And with the remainder, invest in probably a dividend growth ETF like SCHD, because over time, SCHD has, while it had a terrible year this year, but over time, the dividend does grow on your cost basis uh, profile. So depending on when you bought it, depends on how much your dividend has grown. And I think over time, it'll balance out over the course of 30 years. You know, your dividend growth has gone parabolic. You're at like 200, 300%, which is a really, really sweet spot to be in. So I'll probably have half my money in covered calls, half my money in uh, SCHD, and use my income to fund the SCHD. And actually, you know what? I would probably still keep a little bit in growth. And when I say in covered calls, I won't just dedicate to one covered call. Diversity is important. So I may have some TDAC. I may have some, if they fix GIX, I will have some GIAX. I'll have some QQQI. I'll have a little bit of JEPI. I'll have some Devo, but just trying to reach that general yield of about 10 to 12K. So that's how the numbers work out. And let's just go over some of the ledger trade-offs. You can retire faster with 50 to 70% less capital. You get immediate high income. Outperforms in down markets. So if the stock market is crashing, you don't your sequence of risks is less than a person who's strictly doing the 4% rule because you're not selling into a down market. And then it's tax efficient return of capital, which is just lowering your cost basis for how much you paid for the ETFs. But once that cost base reaches zero, you will be paying capital gains. Now, depending on how clever your accountant is, you may be paying long term, short term, but you will be paying capital gains. The liabilities, lower ending portfolio value usually. The hybrid approach will offset some of that and boost you up. But you'll have if you do strictly cover calls, you will be leaving behind a smaller inheritance. Capped upside in bull markets. If we reach 100% abundant society and the stock market just goes straight up, you're going to be capped out. You're going to be capped out. You are giving up your upside for income now, and requires an income focus over growth. As you see, let's say you have a friend who's doing the traditional 4% drawdown. While you have $2 million, he's going to have uh 8, 9, 10, 11, $12 million. That his compounding will really get aggressive. And there is no rule that says you have to continue to do the 4% rule. He might decide, hey, you know what, I'm gonna take $1 million out and do something else. It just gives him more options the more time goes on. And here's the real question that you have to ask yourself. Would you rather wait 15 years to save 1.5 million or retire today with 600K? And for me, the answer is easy. I will retire today. I'm not going to spend all of my dividend income on I'm not going to spend 100% of my dividend income. I'm going to be taking that and reinvesting it into other assets that can potentially outperform. So I'm gonna sign off here. Please like, subscribe, drop a comment. Would you rather save that 1.5 million with traditional fire or retire early with 600,000? Let me know. Let me know what covered call ETFs you would use in to reach your fire, or if you're doing the traditional 4% drawdown. What is your fire number? Please like and subscribe for more content just like this, and also leave me a uh, leave what ETF you would like to see reviewed again, or what not personal finance, but what markets based topic you'd like to cover. I'm thinking about doing something on options trading, but so many channels have stuff on that. I would have to show you exactly kind of the options that I do to grow my account. But with that, I'm going to sign off. God bless, and you guys have a great day.